Good morning, it's Tuesday the 21st of September. I'm Tom Elliott and here's my market report. Now, US shares continue to rally overnight. They rallied for different reasons than what you would see here in Australia, although nevertheless it's had a strong positive mood on our market as well. But the reason shares are going up there is that investors are absolutely certain that the Federal Reserve, that's the American Central Bank, is going to indulge in another bout of what they call quantitative easing. Now, in old-fashioned speak, this is called money printing, although they don't actually print it anymore. It's by an electronic transfer. Now, money printing is the last resort for an administration that is desperately trying to lift the American economy out of a potential second recession. It does mean that hopefully there'll be more consumption in the American economy, which they desperately need. Now, in contrast, here in Australia, you had the Reserve Bank head Glenn Stevens, who spoke in Shepparton yesterday, and he's given some pretty strong hints that the Reserve Bank here intends to do pretty much the opposite fairly soon. That is, rather than print money, they're going to lift interest rates. That is, make the price of money more expensive. I think if you're a homeowner or a potential homeowner at the moment, you really need to factor in an interest rate rise of around 50 basis points, half of 1% over the next few months. Now, despite this, Australian bank stocks are doing very, very well. We saw that the head of the Commonwealth Bank, Ralph Norris, got a big pay rise for the year to come, and a lot of people have said, myself included, that I'm not really sure he deserves it, but he's got it anyway. Personally, I think bank profits are going to struggle a bit this year. It doesn't mean they'll fall, but I think they're going to struggle to keep increasing them because the cost of funds is going up. I think if interest rates go up, the consumer is going to take out smaller loans, fewer people will buy houses and so forth. The other big issue, as we discussed in the Father and Son report, was of course the carbon tax. Now, I hope I've made the point clear over the last sort of several months, but a carbon tax will not be neutral on Australian households. Someone has to pay. It's becoming clear, even though this issue wasn't discussed at the election, that it will be levied primarily on electricity or electrical power generation, because that is the source of around about 40% of Australia's greenhouse gas emissions. So the end user, which is businesses and households, will almost certainly pay a higher price for electricity, and that could put household budgets under a bit more strain. In takeover land, well, lots happening. This morning, the Foreign Investment Review Board has approved the takeover of Centennial Coal by a Thai company called Banpu. That wasn't really a surprise because we have a free trade agreement with Thailand, which interestingly is why we get such cheap Hondas here at the moment, because they're actually made at a plant in Thailand and they don't attract any duty when they come into Australia. Think about that when you buy a Honda City or a Honda Jazz. Even, which is the retirement village operator, they've decided reluctantly to approve a takeover by Real Estate Trust Stockland. The bid's $1.80 a share. Even thinks it's worth more. In fact, it priced its own shares at around about $2.06, but it knows that there isn't another takeover coming, it seems now. So $1.80 a share is probably what you'll get. And AXA Asia Pacific, of course, still now looking for a buyer. The ACCC has said that it will not allow National Australia Bank to buy it. AMP is still circling around, but can't pay the price that AXA's board wants. My tip is that AXA's French parent, which is called AXA SA, will probably decide to buy the company and then sell the Australian part of it to AMP. So that could be a good result for AXA shareholders. Foster's, don't know if it's a takeover yet, but it's received at least one and possibly now two bids for the Treasury wine business. Now, wine has been a disaster for Foster's. They do need to sell it. I think if they get a bid somewhere between $3 and $3.5 billion, they probably will sell, and that will mean that the then pure beer business is also likely to get a bid, possibly from SAB Miller, which revealed a day or so ago that it has been doing due diligence on Foster's, so look out for that. Finally, the gold price. Now, I spoke about the US money printing at the start of this report. One of the byproducts of printing money is that the prices of hard assets go up. The more money you have, and therefore the higher the price of things. Of course, the American government would hope that house prices will go up and hopefully security prices and so forth. Something that is definitely going up and has always done so historically whenever governments decide to print money is the price of gold. It is at an all-time record. I don't mean all-time since 1980 or all-time in the 20th or 21st centuries. I mean all-time since records began in human history. It's $1,280 an ounce, and it says that down the track, inflation will eventually come back from the American government. So that's the reason interest rates are going to go up here. It's not good news, but it's how I perceive the market to be going at the moment.